At its core, Alphabet is still one of the most dominant and profitable tech companies in the world. Its business is massive in scope, spanning digital advertising, cloud infrastructure, consumer hardware, autonomous driving, and of course, AI. But as broad as Alphabet is, its core revenue engine is still advertising, and more specifically, search and YouTube. Search advertising is still one of the highest margin segments in tech, and Google owns over 90% of that market globally. That dominance gives Alphabet consistent pricing power, strong network effects, and immense data insights, which feed right back into their AI development. But let's break down the fundamentals. From a valuation standpoint, Alphabet currently trades at about 20 to 22 times forward earnings. For a company with Alphabet's margins, growth rate, and cash flow profile, that's not a premium, it's a modest valuation, especially when you consider that many lower quality tech firms are still trading at similar or higher multiples with significantly more execution risk. When we strip out the company's massive cash pile, over $110 billion in cash and equivalents, its enterprise value to EBITDA becomes even more attractive. You're essentially getting world-class infrastructure, recurring revenue, and enormous optionality at a fair price, even after accounting for the current volatility. Speaking of financial strength, Alphabet's free cash flow is one of its most impressive metrics. Over the last 12 months, the company generated more than $70 billion in free cash flow. That's net of capex, taxes, R&D, and other reinvestments. That kind of liquidity gives Alphabet an edge few companies enjoy. It can fund internal innovation, invest heavily in data centers and AI training models, and still return capital to shareholders. And it is returning capital. In 2024 alone, Alphabet authorized and executed over $60 billion in share repurchases, shrinking the float and enhancing long-term shareholder value. Now let's talk about the balance sheet. Alphabet is about as clean as it gets. Almost no long-term debt, massive cash reserves, and robust working capital. That balance sheet makes Alphabet extremely resilient in economic downturns, especially compared to debt-heavy peers in tech or media. It also gives Alphabet optionality, whether that's acquiring AI startups, building custom chips like their TPUs, or expanding Google Cloud's reach. This financial flexibility is a major asset, especially in uncertain macro environments. But no investment is without risk, and Alphabet has its share. One of the most discussed lately is the competitive pressure from Microsoft and OpenAI. Bing integrating ChatGPT has introduced a credible alternative in search for the first time in years. Google responded with Gemini, its suite of generative AI models. And while Gemini is powerful, the launch was rocky and the public rollout slower than expected. That's opened the door to perception risk, the idea that Alphabet may no longer be the clear leader in AI, even if the reality is more nuanced. Another challenge is the fragmentation of user attention. YouTube, long considered the dominant force in online video, is facing growing competition from TikTok, Instagram Reels, and other short-form platforms. While YouTube Shorts has seen strong growth, it's unclear if it's adding new engagement or just cannibalizing traditional YouTube watch time. Monetization of Shorts is still developing and has lower ad revenue per minute compared to longer-form content, which could pressure margins if user behavior continues shifting in that direction. Alphabet also faces increasing regulatory scrutiny. Antitrust investigations in both the US and Europe are heating up, with potential lawsuits targeting Google's dominance in advertising technology and its bundling practices with Android. While the outcomes of these suits are uncertain, prolonged legal battles could lead to fines, operational restrictions, or forced divestitures. For now, these are overhangs rather than existential threats, but they add another layer of risk that investors have to weigh. Despite these headwinds, the long-term growth catalysts are substantial. Google Cloud is one of the company's fastest-growing segments, with year-over-year growth consistently in the double digits. It's still behind AWS and Azure in market share, but it's catching up. And more importantly, it's starting to contribute positively to operating income after years of investment. As enterprises accelerate their digital transformation, Google Cloud's role in AI-based tools, analytics, and scalable infrastructure could become a significant profit engine. Alphabet's AI integration is another major advantage. While the spotlight has been on Gemini, the real value is in how AI is embedded across their product ecosystem. Search, Gmail, Docs, Maps, YouTube recommendations, Android voice commands. Alphabet is making its AI feel native to the user experience. That creates a flywheel effect. More user engagement leads to more data, which trains better models, which lead to smarter features, which deepen the user moat. Very few companies can match that kind of vertical integration. Then there are the moonshots. Waymo, Alphabet's autonomous driving division, has moved from R&D into real-world testing and early-stage commercialization. While self-driving tech is still years away from being fully scaled, Alphabet is one of the few companies with both the capital and the patience to play the long game. Other bets like Verily in life sciences and DeepMind in AI research could eventually spin off or be monetized independently, adding additional value layers that aren't yet fully priced into the stock. From a technical analysis perspective, the picture is mixed. The stock recently fell below its 50-day moving average and is now testing the 200-day, which is a common support level. If it holds the 200-day and forms a consolidation pattern, we could see a reversal and push toward prior highs. But if it breaks lower on heavy volume, a retest of deeper support zones, perhaps around 10% below current levels, is possible. The RSI is in the low 30s, nearing oversold territory, which could trigger a short-term bounce. However, technical setups work best when they align with fundamental strength. And in Alphabet's case, that alignment may be forming. So where does that leave us? Alphabet is no longer the hyper-growth rocket ship it was a decade ago, but it's matured into something arguably more valuable, a high-quality compounder. It's got a wide moat, diversified revenue streams, elite returns on capital, and more financial flexibility than almost any company in the world. Even with macro and regulatory uncertainty, the company continues to innovate, execute, and reward shareholders. For investors with a short-term horizon, caution is warranted, especially while the technicals are weak and sentiment is jittery. But for those with a 3 to 5 year view, this pullback looks more like a reset than a reversal. Alphabet at these levels is trading at a fair price for a great business. And historically, buying great businesses at fair prices, especially when they're temporarily out of favor, has been a recipe for strong long-term returns. If you found this breakdown helpful, make sure to give it a like. It really helps the channel reach more investors like you. And if you want more deep dive stock analysis, market insights, and long-term investing content, don't forget to subscribe and hit the notification bell so you never miss an update. Thanks for watching, and I'll see you in the next one.